Hey everybody, Kyle, not your average finance guy. I want to talk to you today a little bit about doing some investing and what you can do with a little bit different way of thinking about things. So I've got some rental properties and talking to a person that I used to work with, and he's got some rental properties and trying to get some more cash flow, if you will, buying them, having, rent them out, let the renters pay all your bills. Hopefully at the end of the month, you got a couple bucks of cash flow left over, another way to make some more income. But the way to do this is you can do it the way he's doing it now, which I'm going to go through and show you, or you can do it like the velocity banking or the infinite banking concept, which is kind of what I'm going to go through here next. So let me switch screens here and back. I'm trying not to bore you to death with the spreadsheets, but the way this guy's doing it right now, we got the Wall Street Bank here, and he's got a $150,000 home equity line of credit, so he can go ahead and he can buy a house for cash. Doesn't have to go, worry about a bank loan. You've got that at your fingertip. He's got roughly $2,000 of monthly cash flow, and with every property that you buy, hopefully you've got another $250 of cash flow that we can up this amount by, which will just help the whole process. So basically what he does is, say month 1 or 0, whatever, we're starting out, and he finds a house that needs some work for $80,000. So he takes a loan out from the home equity line of credit for $80,000, buys the house. You got to pay $530 of interest back to your HELOC. The second month, it's going to take about 20 grand in rehab. Now your balance is up to 100,000, and the interest only payments is up to 667. And we got another 20 grand to rehab going in, brings the balance up to 120. And then the fourth month, we're now basically done with the rehab. We're trying to get it rented out and do a cash out refinance with the bank. So we'll say in the fifth month, the new after repair value of this once $80,000 house is now worth $150,000. He goes to the bank, said, "Hey, look at my $150,000 house." The bank says, "Okay, I'll give you a loan on this for $120,000. So they give him $120,000 cash. He pays off the home equity line of credit, and boom, now he's done. That money goes right back in, and he can recycle, and you can do this as many times as you want. I'm not going to really get into any of the other numbers. Basically, we'll say that the renter takes care of all of the PITI, the principal, interest, taxes, insurance, and at the end of the day, there's still some money left over with the cash flow in your pocket. Doing it this way, which is a great way to do it, you don't have to really ask anybody. You get the whole job done, you get it rented, you get it cash flowing, and then you go to the bank and say, "Hey, can I get an interest rate that's hopefully better than what you're at with your home equity line of credit?" This whole thing recycles. You can do it again. Doing this, it took us $2,800 of interest only payments, and that's it. Everything else, we basically cash out refied that $2,800, went to big Wall Street Bank, and let's say we can do that twice a year. So at the end of the year, we'll do the exact same numbers. You get this one done, take a month or 2 off. Oh, good, found another one. Going to take 5 more months to do this. Again, $2,800 goes back to the bank. So in that year, in that hypothetical year, $5,600 was charged in interest. So that's fine. And I would say, let's keep on doing this. Okay, this is a great system. Keep rolling with that. But what you want to do is let's start capturing some of this money. Let's take our money back. Let's make our own banking system. So watch what we can do here with that. So with our own banking system, we're going to assume that if there's 5% growth, there's a guaranteed portion, and there's a dividend portion, which is not guaranteed. But this is purely just assumptions here. This is your own banking system, which is guaranteed whole life insurance policy through a mutually owned company. So the loan rate, you can take a loan against your cash value at 5.5%, which is pretty close to where everything is at right now. So what we're going to do is month 0 is we're going to take, remember that home equity line of credit we had it was $150,000 that we had, and to do this deal we used $120,000. So we really have $30,000 left in there that we could use, but you don't want to get backed up to the wall. So everyone's different here. If you want to do this, you can talk different numbers. You want to leave yourself a little cushion. So what I did here for him, I used $20,000. So if you borrow $20,000 from your home equity line of credit, and then within 30 days, you've usually got 85 to 90% of that, whatever you put in, is now available for a loan. Okay, so Your prior loan balance here is zero because we're just starting all this out. Now my HELOC balance is $20,000 because remember, that's what I used to fund this policy. So I took $20,000 for my HELOC, I fund my policy, and within 30 days, you should have about at least $17,000 available for your use. Okay. Now you've got home equity line of credit interest that you have to pay. So this is still month zero yet, but let's say come down here for the first month. First month, you're going to borrow your $17,000 against your cash value now, and you're going to put that right back in your home equity line of credit. Okay. So our 17,000 goes over to here. So now we've got a policy loan against our policy, and our HELOC balance now is down 17,000. So that's now down to 3,000, and the interest on that 3,000 is only $20. So that's cool, right? And over here we've got interest at 5.5% on the 17,000, which is $78. So what we're going to do then is we're just going to keep knocking off this home equity line of credit balance because that's where our high interest rate's at. Okay, so remember we have $2,000 of cash flow, and we're going to use that every month. We're going to use the cash flow to pay down the HELOC, and so that's going to go down to $1,000, and for that you only have to pay $6.67. The following, we're going to use the cash flow to pay off the HELOC, and the rest is going to go back to our policy. So 1,000 goes here, knocks that down to zero. We got our other 1,000 here, takes it down to 16,000. I'm not paying any of this yet. Okay, all we're doing is we are knocking down the principal of this policy loan. All right, and if you look at this column, this is where the magic really happens. Okay, we put $20,000 in. The way this compounds, you're always compounding. You're always making money. So with this, see, look, after a month, it's $83. It's 167. Looks like I maybe missed a month there, so it's even better than this. But this keeps growing every month. Okay, your cash value keeps on growing as long as you keep this policy current. So if you come over to here, if you can take 85% of that loan, see, look here, we took 100% of it. The following month, you can take another $70 loan. Okay, but that's not the point of this. We're going to try to pay this back. So we're going to try to knock this down as fast as we can. So every month we're going to use our cash flow, knock it down by 2,000, knock it down by 2, knock it down by 2. And lo and behold, here by month 11, we have paid this off. All right. We've got a total of $485 of policy interest. And what we'll do there then is at the end of the year, this doesn't accrue unless you don't pay it at the end of the year. So at the end of the year, what I do is I take all of my policy interest, I make sure I pay that, so that here at the end of the year, 12 months, we pay our policy interest and hold the rest of the cash flow for our next policy. So we're going to pay that off. And then year 2, now look where we're at. We need to put another $20,000 in, okay? But remember, right here we have 0, so we've got some money that we've saved against putting towards our next month's or our next year's premium. Sorry. So our cash value at the beginning of the second year is $41,196. We've put in $40,000. This is the part that took me forever to get my head wrapped around. I've put $40,000 in, and I have access to $41,196. That's my cash value. My cash value continues to grow every month, no matter if I take a loan against this or not. This is like taking a loan against the equity of your house, just like your HELOC. Your house doesn't go down in value. Your house, this is your hypothetical house, is still, this is 5%, still growing every month, right? Now, here we've got to take a policy loan of $16,500 this year. And look, we don't need to take any more home equity line of credit loans because we've now got a cash value of $41,000, and we can take I already took the loan out of this, but the $20,000. So you're left with $16,500 policy loan. Okay, because remember we saved our cash, we saved back here to pay towards that cash value, and now here we owe $16,500. So again, what we're going to do, since we don't have to pay our HELOC off at that high interest rate, what we're going to do is we're going to take our premium, or I'm sorry, this is our premium of $3,500, $16,500 policy loan. So the 3,500, remember we saved this, we saved 2,000 here. I called that 500, so I called this 1,500 here that we saved towards the loan. So that's the 2,000 plus 1,500 gets you up to $3,500. So with that, you only need to take a policy loan of 16,500. So here's our policy loan. We're going to knock that down by our cash flow again. Remember, you're still using your home equity line of credit to hopefully buy 2 more properties, and hopefully your cash flow is going up by $250 every time you buy another property. So if that's the case, you're going to knock these balances down way faster than this. But I'm just using worst case scenario, and we're going to knock these balances down, the loan balances, by $2,000 every month. Here in month 9, you're left with $500. All of our interest added up now this year is only $275. So let's use our cash flow to pay off the loan of $500. Okay, got that cleaned up a little bit. So we're using our cash flow every month to knock this down, right? We're going down here to month 9, use our cash flow to pay off the loan of $500 and the policy interest of $275, and we'll hold the $1,000. Okay, so that means it gives you a little bit extra to do whatever you want with. We'll hold the $1,000 here. We're going to hold this $2,000. We're going to hold this $2,000. So that's $4,000. That's $5,000 now that we're going to put towards the next year's premium. So we held the cash flow of $5,000 plus the $15,000. We're going to take another policy loan of $15,000, and we're going to dump it back in here to the cash value. Cash value goes up by $20,000, and this is the percentage that now starts to gain the interest and the dividends on. Okay, so again, take this every month. We knock this down by $2,000. This time we got it paid off in about 8 months. We've got a total of $293 of interest this time around. And from here, what we're going to do is we're going to use this to pay off our loan plus our interest. So our $1,000 plus our $293, and then we got $2,000, $4,000, $6,000, $8,000 that we can hold on to. We can put towards our next policy year or our premium. Okay, this is year 3, and we've got a held cash flow of. We held the cash flow up here of $8.3 thousand, so we got an $11.7 thousand loan. Again, knock it down by $2,000. Like I said, this is probably going to go way faster, but I'm just using conservative numbers. Okay, knock that down. We've got interest of $184. So here we are going to pay off the loan. We're going to call it $2,000 just for even numbers, and we are going to save $2,000, $4,000, $6,000, $8,000, $10,000, $12,000 is what we're going to put again towards this in year 4. So year 4, we've got $12,000 that we've saved up, and we're going to take an $8,000 policy loan now, and to make this to add on to our $20,000. Okay, our cash value every year goes up by $20,000. We have to make that $20,000 premium payment. So with that, 8 goes down by 2, 4, 6. Sorry, it goes down by 2,000 to 642, and here we are now paid off in year 4. We got a total of $92 of loan interest to pay back on that. We are going to use the save the cash flow now. Look what we got now: 2, 4, 6, 8, 10, 12, 14, 16,000. All right. So we got 16,000 plus for now this year. In year 5, we only need a $4,000 policy loan. So look what happens if you can do this for 5 years. Now, basically, you're paid this in 2 months. You're paid off. Okay, you no longer need to worry about these policy loans because you'll be able to save this up for the next year. Because look here: 2, 4, 6, 8, 10, 12, 14, 16, 18, 20,000. You can save your cash flow and put that into next year's premium. Okay, so you no longer have to worry about taking a loan from your policy. Here's where the magic happens. Just like when we started, what we did was we would take a loan from our home equity line of credit. But look what we have available to us now is we've got $121,000 available to us, okay? We still have our $150,000 home equity line of credit. Hopefully we've been doing this. We've been buying 2 properties a year for the last 5 years. You got 10 more properties. That's another $2,250 of cash flow. So hopefully you're up about $5,000 of extra cash flow that you can use to raise all this up. But let's pretend that never happened. But in year 5, we have replaced your HELOC basically. Okay, so property 1, we're going to buy this for $80,000. instead of, I still have a HELOC in here. I'm sorry. Instead of taking a loan out from your HELOC, let's take it out from here. All right. From your available balance. And then the next year, the next month, you got to add $20,000. You add another 20. You've got 121,000. Say this costs 130,000. You then take 10 grand from your home equity line of credit. Okay. So this interest here is at the rate of the policy. Now this is at 5.5%. Okay. This is calculated at 5.5%, where your HELOC was calculated at 8%. So we're paying $19.25 in interest. If we do that twice a year, we're paying $38.50 back into your own policy. Okay, so yes, you have to pay a little bit of interest in order to do this, but throughout that, let's say the 6th year, the beauty of it is right there. That number, that's your cash value. That number keeps growing and compounding on itself month after month after month, no matter if you've taken a $120,000 loan or no loan. This number continues to grow. So you're always watching at this number. So it's like your money is growing, and you can also use it. If you did that in a savings account, if you had $120,000 in your savings account and you used it to buy a property, that money's gone, and you're not earning any interest on anything because there's nothing there. All right, so if we scroll down here a little bit more, what this does now is I took this year by year. This is the year 6 through 10 cash value. Don't jump ahead much. So what happens after 10 years? You've got $243,000 available to you. What do you have in your HELOC after 10 years? Maybe you can go back to the bank and you can ask for a bigger line of credit. $243,000. Maybe it's there, maybe it's not. This is virtually, I can't say guaranteed, but there's a good chance that it's going to be there. Okay. Scroll down another 10 years. Year 20, you're going to have $615,000 at your disposal. Your HELOC going to be there? Don't know. Take it down another 10. This gentleman I'm working with is in 30 years, he'll be 67 years old, maybe about retirement age. What would you do if you had access to another $1.23 million? You want to keep doing deals? Maybe you want to ride off into the sunset. You can take a loan against this, and guess what? You never have to pay it back. That's right. You don't have to pay it back. They just take it out of your death benefit. This is life insurance. We're not using it to insure our life. We're using it to make our life better while we're still living, okay? I don't even care about the death benefit, but that's why you were able to borrow against this cash value, is you're borrowing against the death benefit, all right? Most insurance policies will go out there our whole life, so they'll go out to either year 100 years old, or some now we're going to 120 years old. So yeah, look here at year 60 when he's 97, it's worth $6.6 million. And as we keep going, if there's a bunch of medical breakthroughs and he makes it to 120 years old, this will be worth $21 million. And guess what? If you die somewhere in there, your heirs get this, okay? So this is a great way to take the function of the HELOC away from the bank. Let's take it away from Wall Street. Let's keep that for ourselves, and let's keep building our own banking system. And look, at what year? Maybe you're into this for what's year 15? We got $406,000. Maybe you want a big multifamily. Let's go year 20. You know, where do we cross a million? Right here, year 27. You got $1 million, access to $1 million cash. You can pay cash for something. That's a $4 million property, or 25% down. So you can really do anything with this. It's a good tool to have in your tool belt. Highly recommend it. But you do you, and let me know if you got any questions. Thanks.